equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, or should I say, hey there, my friends. It's your lightning fast buddy, and welcome to another electrifying episode of Equity Mates, where we're not just sprinting through the world of investing, we are breaking world records. As always, I'm joined by my equity buddy, Ren, and who am I?
Bryce, you are Usain Bolt?
Yes.
I actually was going to say you're Lightning McQueen. Now, that's a reference that I don't think you'll get.
I don't think so, no.
No, you haven't seen the classic Disney movie Cars.
Not to be able to reference that,
Yeah,
no.
your pop culture knowledge is subpar. But Usain Bolt...
Correct.
Done it again.
Well done. He's done it again. Note for producer Sasha, we need to make this harder, please.
Well, Bryce, like Usain Bolt, we've got a lot to get through in a short space of time. That analogy doesn't quite work because he actually runs shorter distances.
Yes.
Like Lightning McQueen, let's keep rolling.
Yes.
We're here to talk all things investing. And as a reminder, as we get started, whilst we are licensed, we're not aware of your personal financial circumstances. This show is for education and entertainment purposes only. The one drawback of getting ChatGPT to translate your introduction is that the disclaimer often gets lost.
Well, we can get ChatGPT to do the disclaimer, but I feel like that would be legally irresponsible anyway.
Anyway, a lot to get through today. We're answering a question from Equity Mates listener Will about all things leveraged ETFs, and the timing on that was good because you've done a lot of work on leveraged ETFs recently, so excited to hear about that. We're going to be rejoined by Speccy Magee. Now, people who are new to the show, first of all, welcome. Secondly, you're in for a treat. Speccy Magee is our anonymous Speccy tipster. He gets a lot of information across his desk that he brings to the show via the Speccy
Information
hotline.
is debatable.
Yeah, we'll get to it. But first of all, Bryce, let's get to the news of the moment because there is a lot going on. The earnings fire hose continues over in the United States. But first of all, unfortunately, we are in a correction.
We are in a correction, Ren. It's sort of snuck up on us. Now, technically, a correction occurs when the market drops 10% from its high, and then you hit a bear market once you're 20% or more below the most recent high. Now,
technically, I actually don't think we're in a correction in Australia.
No, sorry, US.
Yeah.
Yeah.
And technically, I actually think we've already come out of it.
Oh, really? We've bounced back since the time of writing this?
Yeah, I think I was looking this morning and I think it's less than 10%.
Oh, damn. Well, at the time of putting that in the note, we were at 10.
But like, there or thereabouts, the number is kind of arbitrary, 10%, 9%. The fact of the matter is we've seen a bit of a sell-off recently.
Yeah, well, the market seems just to be going sideways at the moment, like within that sort of 10%. And this is sort of from, I would say, I'm not going to say it was from sort of late July.
Sorry, you said I'm going to say, and then you said I'm not going to say, and then you said it anyway. So,
well, I mean, it alluded to that I was just going to make up an arbitrary date and be like, oh, I reckon it was from this point in time. But
so did you or?
No, that's what I said. Anyway.
No, keep that.
So from mid-July, it's been trading sideways somewhat, and the trend has been down. I think at the time of looking into this.
Sorry, from mid-July, it hasn't been trading sideways. It's down 10%.
Well, we're back up.
It's down now 7.5% from the end of July.
Yeah.
So in the last week, it's up about 3%. For me, like all of this conversation is so arbitrary and so short-term.
Yeah.
American market's up 11% for the year.
Yeah.
Crazy. The Australian market, ASX 200, is down 2%. But yeah, for me, it's just
the Nasdaq's up 35% year to date.
Yeah. And everyone talks about the Magnificent Seven.
Yeah.
The big tech stocks who have, this is S&P 500. Without the big seven, I think the S&P 500's up 0.1% or something. It's like they've just driven it. Big tech stocks.
And they continue to. Year to date, 35%. I think my bold prediction was going to be 3%.
Yeah, well, we were coming into the year and things were looking pretty gloomy.
Yeah, very gloomy.
Anyway, look, I think my thoughts on this is the overall market is driven by the performance of individual companies, and the performance of individual companies is really tied to the broader economy at the moment. And The story that we've been living through all of last year and all of this year is the inflation and interest rate stories. And here in Australia, that story had another page written with data that came out last week from the Bureau of Statistics.
Yeah.
This data for the September quarter, inflation data, surprised on the upside. And in this case, surprising on the upside is bad. The consumer price index rose 1.2% for the quarter. Economists expected 0.9%. Now, that difference doesn't sound like a lot, but the fact that it was higher than expected isn't great. The 12 months to September 2023, inflation is 5.4%. Again, higher than desired. And what that means is that higher rates are coming.
Higher rates are coming. Interestingly, overnight, the Federal Reserve at the time of recording held rates where they were in the US.
Yeah.
But the sense was that they're definitely not going down for a while.
Yeah.
Yeah.
Now, there's no certainties in life and investing, but it's the Melbourne Cup next Tuesday. And there is a short odds favourite for next Tuesday. And it's not any of the horses running.
It's an interest rate rise.
It's an interest rate rise because the RBA also meets on Melbourne Cup Day, first Tuesday of every month. Melbourne Cup is first Tuesday of November. I was listening to Comedian v Economist this morning. Great podcast. Go and give it a listen. Also, Adam from Comedian v Economist hosted the Buy, Hold and Sell episode that came out on the Equity Mates podcast last Tuesday and will be out again tomorrow. And so go and listen to CVE if you want more from Adam and his brother Thomas. They were talking about the potential of an interest rate rise and this inflation data. Bond market is is giving it a 90% chance that there will be an interest rate rise at this meeting. 90%.
So if you rewind 6 months ago, maybe within the last 6 months, the consensus has been that there will be one more rate rise this year.
Yeah.
But I think that was probably said at a time where these inflationary pressures were not surprising on the upside. What is also interesting, we were talking in the office before recording, is that house prices are at near record highs again here in Sydney, and the RBA needs to take the sting out of this stuff. So
I don't think,
it's
I don't think that that's possible
no.
with the migration numbers.
But then do they then need to look at how they're actually measuring, because housing costs, rent goes into CPI.
Yeah.
We're moving out of our house we bought a house, obviously.
Yes.
I told my landlord that we were moving and that we had some mates who wanted to move in and could take over the lease. They were prepared to pay more than we were currently paying. We're currently paying $750 a week for call it a 2-beddy. It's a 1-beddy plus a small study. They then went to the landlord, who has already increased our rent 25% in the last 12 months. The landlord came back and said, I'm taking it from $750 to $950. $950 a week.
Yeah.
$200 increase in rent. And you can't, they just said, we know we're going to get it.
Yeah.
We're going to get this. And so far out, how do the RBA take that into consideration? Interest rates, I mean,
interest rates are a pretty blunt instrument. And when the two biggest contributors to the continued inflation numbers are housing costs, which is just a supply and demand problem at the moment, and fuel. Which is a war in the Middle East problem at the moment.
Yeah.
There's not a lot that interest rates can do except destroy demand.
Yeah.
And that's an economic term for literally just price people into
Make
not
it
being able to
impossible
spend.
to spend.
Yeah.
Which is not a scenario we want to get
So
to.
there's not a good answer here. The IMF also came out last week and said that Australia needs to keep lifting rates to bring down inflation. But it's, interest rates could go to 8%, but if there's war in the Middle East and we're adding double the amount of people as houses we're building, it feels like structurally you don't have a good answer there. So unfortunately, this is the very unsatisfying part of the show where we lament something.
Well, I'm just
that
thinking we should probably
have a lot of
we should
control
probably
over.
try and get Chris on the phone for 15 minutes. But that'd be near impossible.
Chris Joy?
To get his sense, because as we've said multiple times, he has somewhat thought that there's another large tranche of rises coming. So Anyway,
Well, to close out the interest rate conversation, last week we spoke about the choice between fixed and variable rates for
Yep.
your home loan.
Yep.
I asked in the Facebook discussion group after the episode what people thought. Not surprising, strong opinions.
variable.
The majority thought variable. Yeah, the majority. There was one Ryan in the Facebook discussion group. He made the point that the house always wins, and the banks in this case are the house, and they're going to put a fixed rate at a point where they are going to win.
Yeah. Which is what they've done. We've figured out. It's like,
My thought back to Ryan is that the house certainly didn't win the last few years.
with fixed.
Like people who fixed their rate when there was a 1 or a 2 in front of it,
True.
they definitely beat the banks. So I don't know if the house always wins. I don't know. Like for me, you know, what we're talking about now, is there not going to be another one rise? You probably want to stay variable. If it's going to be like 3,
if
4,
you're looking, yeah.
then you want to be fixed.
Yeah. The good news is it doesn't have to be a decision that is made and
Yeah.
locked in from day one.
Yeah.
So that's probably allowing me to sleep at night. Yeah.
Well, I mean, the good news is that your rent isn't going from 600 and something to 950.
I know.
Yeah.
It's unbelievable. It's greedy.
Oh, let's not get into that.
Yeah.
Yeah. All right, let's move on
Anyway.
because there is plenty more
Anyway.
news happening.
Yeah.
Twitter,
X.
X.
Headline that grabbed my attention this week. They, if we rewind to when, I've said rewind twice now, rewind to when Musk bought Twitter at a $44 billion valuation, had to borrow, I think, or he put in about $14 or $15 billion himself, borrowed the rest from the big banks. It is now valued at $19 billion, so he's wiped off a considerable chunk. This is based on the shares that are now being offered to staff members at $45 a share. So that's what X are valuing themselves at, $19 billion. Rumor has it that Musk is trying to drive this company down to a point where he can then buy back the debt from the major banks that took it off him or that have, I guess, given him the money, and then he can take full control. Apparently, in a situation where these big investment banks come in and do buyouts like they have, they then actually go and on-sell the debt to, but no one's buying the X debt at the moment. So they're stuck with it. So there's rumours that Musk himself wants to buy it back. Speaking of companies down the toilet, Ren, also WeWork are rumoured to be filing for bankruptcy within the next week or so. The share price has tanked 50%. It could be the end of WeWork.
Yeah, what a story. That was, what, a $45 billion company at one stage?
Yeah.
Adam Newman, the founder, walks away with $1 billion handshake as part of the, he was
just
forced
wanted
out
his
of the
$1
company,
billion,
and he got $1 billion to walk away, which is more than any WeWork shareholders will get.
It's currently worth $121 million.
Yeah.
Unbelievable.
Crazy.
Unbelievable. But anyway, let's move to the earnings because it is continuing over in the States, and we're going to just do a bit of a summary. Last week we did big tech, and big tech is getting bigger. But there are some other key takeaways that are coming out of this reporting season.
Yeah, 2 key ones. First one is the inflation story continues.
Yep.
Now, over in the US, the Federal Reserve decided not to raise interest rates, kept them in that 5.25 to 5.5% band. So it's meaningfully higher than Australia's. But what we're seeing in companies reporting numbers is inflation coming through. So McDonald's reported a 14% increase in revenue and an 8% increase in same-store sales despite falling foot traffic. So less customers, but increasing revenue means one thing.
Increased prices.
Yeah. And don't get at me about increased basket size because it's not that. It's increased prices that are driving this.
Yeah. Increase in the Big Macs and whatever else.
Are you just
they're
going to list them
selling.
menu items?
I was thinking I'm not even going to go there.
And then another big food player, Coca-Cola, they reported an 11% in non-GAAP revenue growth, so like how they account for it. So 11% revenue growth, just for simplicity. And they said that was made up of 2% volume growth, so selling more Coke and other products, and 9% price or mix growth. So mix is like selling more expensive products, but again, it's the price of the products going up.
Yeah.
So 2 big American staples, inflation is coming through the system still.
We saw that with Coles and Woolies, I think, when they reported. So not surprising, particularly in retail when this is all pushed through. Second takeaway, Ren, the EV hype has now turned into the EV reality. Yes.
Stop thinking about EV companies as tech stocks and start thinking of them as capital-intensive, low-margin manufacturers.
Yeah.
Because that's what car makers are, and the reality is starting to hit for a lot of these companies. So Tesla's share price is down 18% since it's reported a couple of weeks ago. It had to cut prices to hit sales targets. So obviously that affected revenue and profit. Ford, who have made a massive bet on EVs, I think they said they were going to spend $12 billion over a certain period of time. Their EV business unit posted a loss of $1.33 billion for the quarter, which was bigger than the quarter before. They had plans to build a mega campus for lithium-ion batteries in Kentucky in the States. They've put that on hold. They've got another big project they're building in Tennessee that's going to go ahead, but they are slowing down their spending as their losses increase. General Motors is also pushing back production of its new slate of EVs. Again, just demand isn't quite where they want it to be, and pricing is not quite where they want it to be.
Yeah, so it feels like they've all taken bets when Tesla was absolutely screaming away. They've all taken bets, want to get in the game. I think that's an interesting point though, Ren. I can't remember where I heard it. Maybe it was on a podcast or on the news, that there was a survey done maybe 12 or 18 months ago to see the desire for Americans to buy EV vehicles. That has now, they've redone it, and it's now got worse. Like more Americans have said they're less likely to buy EVs now than they were 18, 24 months ago. It's an interesting story, like across the board as well. Just ESG generally feels like
it's out of fashion.
It's out of fashion. Yeah. Like funds are getting pumped. A big investment, I guess, firms that had all of this strategic plays around ESG are pulling back on what they're doing. It's really interesting to see how the consumer is changing their tune when it comes to this stuff.
It'll turn.
Yeah.
Yeah.
But anyway.
I've seen a lot more Polestars in Australia. I don't know if you've noticed that.
What are Polestars?
The EV.
Is that the T?
Yeah. I think it's meant to be
I know what you're talking about.
Yeah. I got in an Uber and it was one of them. It was pretty nice. The thing that all these EVs have big sunroofs.
Yeah, nice.
Like Tesla's got them. Yeah. This one has it as well.
I want an EV.
Yeah.
Yeah, it's just really hard when you don't have somewhere to be able to charge it.
That is a key consideration, yes. I think the EV story isn't going away. Like, it's just that there's more competition, and you're right. There's a general sort of anti-ESG sentiment in some parts, but the story is also these Chinese and European car makers are having a red hot crack. Like BYD continues to go from strength to strength. The Chinese car maker and more of the Europeans are getting involved. So it's just it's car making has never been as
sexy and
as
profitable.
sexy as maybe in like the early 1900s when.
And these car makers also don't have someone like Musk in the media leading them, pumping them up, being the salesman that has really led to half of Tesla's valuation.
Like for EVs to get where they need to be from an environmental perspective, we've got to stop thinking of Teslas as luxury cars, like the Ferraris and the Lamborghinis, and start thinking of them as Toyota Camrys.
Yeah.
And Toyota Camrys are mass market, low margin products. Yeah. And that's just the reality that these car makers are finding themselves in. Yeah. Nothing wrong with a Toyota Camry though.
No, 100%.
All right, Bryce, let's take a quick break here. And then on the other side, we have a question from Will. He wrote through on Instagram to ask about leveraged ETFs. And you've done a lot of work on that, so a good time for us to chat about that.
Hey Equity Mates, Bryce here. Have you caught up on our new series, Ask an Advisor? It's when we put questions to some of Australia's best professional financial advisors from you, the Equity Mates community.
Hey Bryce, Ren, I've got a question.
How do you recommend managing a share portfolio with employee share entitlements?
What happens to that money? That's probably one of my biggest concerns.
When is it okay to let emotion drive your investing decisions?
Ask an Advisor. Live in the Equity Mates feed now.
Welcome back to Equity Mates. A reminder that if you have a question that you want us to answer on the show or you want us to put to one of Australia's best financial advisors, hit us up, ask@equitymates.com. We're going to answer a question about leveraged ETFs. But before we do, Bryce, I've got to say you haven't mentioned a big change.
Your face. If you're watching YouTube, you will understand what I'm talking about. If you are following our Instagram page, you would have seen last week that we are doing Movember. It is that time of year where we shave our faces and grow a moustache in support of raising money for men's health. And Renners has shaved his beard, which has can't remember the last time that you shaved your beard.
Yeah.
But not only that, I can never remember a time where you had no hair on your head and no hair as a beard.
Yeah. Now, I've been wearing a hat so far because I thought I would do on camera the Mr. Potato Head reveal.
Nice.
There you go. The overwhelming comment has been, how much do we need to donate for you to shave the eyebrows as well?
Oh my goodness. Is there an answer to that?
Do we put a number on it?
Is there an answer to that?
What number would you put on it? I know that my eyebrows.
Because I'll just say $10.
True, yeah. Well, I'm asking you.
You should put a number on it, and if someone donates that amount,
if one person, no, if collectively.
If collectively the Equity Mates, community raises the figure, you will shave your eyebrows.
Yeah. Oh, I think that's the spirit of it. Isn't it?
All right. What's the figure?
50 grand.
Yeah, I thought it was going to be high. I'm cool with that. Let's go.
Is that unreasonable?
I don't think that's unreasonable. That would be over a grand a day.
Yeah. If everyone listening to this podcast donates 50 cents, we'll get there.
Yeah. Nice.
Yeah.
All right. Well, there you go. The challenge is on the table. 50 grand and Ren will shave his eyebrows. As I said, if you really want to see this in action, jump on YouTube or check out our Instagram page. Links to the donation page will also be in the show notes and on our Instagram.
Nice. All right, I'm going to put the hat back on. All right, well, let's get back to leveraged ETFs. This question came through from Will.
Hey Bryce and Ren, I'd love to hear your thoughts around levered indices such as the TQQQ or SQQQ given current market conditions. Look forward to hearing your comments. Love the pod. Thanks.
All right, well, thank you for that question, Will. Bryce, you've done a lot of work recently on leveraged ETFs, so I guess over to you.
Thanks, Ren. The work I was doing was actually trying to understand the impact of the fees on leveraged ETFs versus not. So to be clear here, I use leveraged ETFs as part of my portfolio, which give me leveraged exposure to the US market and to the Australian market. So I use GEAR, GEAR is the ticker for Australian, and I use GJUS, GGUS for the US leveraged, and they both track essentially the ASX 200 and the S&P 500. So the equivalent would be buying the A200 beta shares or the SPY, whatever it is for the S&P 500. Specifically, what Will spoke about in his question was TQQQ and SQQQ. They're American ETFs that are leveraged. They leverage the NASDAQ. So the TQQ is long and the SQQ, it's actually an inverse and shorts the NASDAQ. Essentially, what leveraged means is that it amplifies the returns of the index. So let's say it says it's a 3 times leveraged ETF. It means that you should expect 3 times the return of that index.
So the S&P 500 goes up 1%, you should expect a 3% return.
Correct. That is what it should do in theory. The differences between the TQQ and SQQ and the ones that I use, both of the ones I use are beta shares, is the underlying mechanics of it. And so we're not going to get into detail on that, but TQQ and SQQQ use derivatives and options. So they're a synthetic leverage, whereas beta shares actually internally gear the fund and they borrow money themselves and leverage the fund that way. So the question from Will was, how are we thinking about it in the current environment with volatility?
Yeah.
Because in the short term, these products can be pretty effective because you're amplifying the short term price movements of the index. To your point, Ren, if the S&P goes up 1%, you're going to get 3%.
Yeah. Unfortunately, if it goes down 1%, you lose 3% as well. So it works both ways.
Absolutely. Yeah. Long term, though, the debate actually becomes more divisive. The reason being is that the way that these products work is they're matching the daily return, not the annual return or the long-term return. And when you do the maths on it, if you're not careful, it can actually be dilutive to your returns over time. And to sort of give an example of that, what happens is, let's say the index, you're putting $100 in.
Yep.
The index drops 10%.
Yep.
So your value is now $90. If you're just in the normal index, not leverage, you need the market to rise just over 11% to get back to that $100.
Yep.
In a leveraged ETF, let's say it's 3 times leveraged, your $100 drops to $70 because it's 3 times the 10% drop. You then need the market to rise, you need your stock to rise 42% in order to get back to even. And because it's leveraged, you actually need the market to rise 14% to get back to even. So you can see there that you actually need the market to move more than if you were just in the non-leveraged index. Where this becomes a problem, though, is it resets every day. And so that happens on day 1. Day 2, if the market drops again, you're already 3% down. And so you can see that over time, if there's large volatility, you actually need huge movements for you to start catching up.
Sorry, what you mean there? Day 1, it falls 10%. Day 2, it rises 11%. If you were non-leveraged, you're back to even.
Yeah.
And then if day 3 it falls again, you just fall again.
Yeah.
But with the leverage product, day 1, you fall 10%. It's actually down 30%. Day 2, up 11%, is up 33%. That's not enough to get back to even.
Exactly.
So then day 3, another fall, you're falling even further.
Exactly. Yeah.
So my takeaway from that is that in times of volatility, leverage products slip.
Yes. And so this has then led me to, all right, let's compare how this has played out over the last 5 or so years, because we've experienced COVID, we've experienced the drop in 2022, etc.
We've experienced a terrible month in 2020, and then a great year and a half, and then a terrible year, and then a pretty volatile time.
Yes.
So we've kind of experienced all market conditions.
Yes. It hasn't been great.
So how's it gone?
So for gear, which is the Aussie one, I then compared this to the A200.
Yep.
Over the last 5 years. So
now, and to be clear, both Gear and A200 track the top 200 Australian stocks.
Yeah.
Gear is it's just under 3 times. It's between 2 and 3 times leveraged.
Yeah. So this is just flat price movement. The ASX 200 is up 15%. Gear is flat.
Oh, really?
Yeah.
In the past 5 years?
Yeah. The reason is Gear started to outpace A200 during the COVID recovery, started smashing through it because there was that period of time where the volatility was just up. And so it's the same. Your leverage on the upside is compounded.
Yeah.
But then it actually hasn't recovered from in the 2022 lows. It started coming back, but because of the volatility we've experienced since the start of last year, which has been overwhelmingly negative, it has struggled to actually catch up to and surpass the ASX 200 index. So it's actually flat. However, if you then look at the impact of dividends, because you're getting leveraged return on dividends, you then it becomes much closer. From just a pure share price point of view, though, it's flat.
Fascinating. Well, I'm even just looking at the 2 charts, and just a cursory glance, you can see that the initial February 2024, when COVID hit and it fell like 30% in a month, the normal ASX 200 then hit all-time highs and passed all-time highs in 2021. Yeah. And by August 2021, so about 18 months later, it was the normal ASX 200 was up 7%. Yeah. Whereas Gear, rather than 30%, it fell 60%. By August 2021, it was just returning to break even. So I guess that's an example of it takes more returns to make up for falls.
It's the market needs to work a lot harder on the upside for you to get back.
This is changing my perception of the two products.
Me too.
Yeah.
Which I want to get to that in a second. So I think it's important to remember dividends.
Yep.
Because you do get 3 times the dividend return. So then I did, okay, well, that's interesting. Let's now look at the US version, which is GJUS, GGUS, and I compared that to SPY, which is the SPDR S&P 500.
Yeah. Yep. So again, both of these products are tracking the same group
S&P
of 500 companies.
Yeah.
SPY is just tracking them, the 500 companies. GGUS is tracking the 500 companies with leverage.
Yeah.
There's also a small caveat that there's a currency hedging element as well, isn't there?
Small caveat that when you look at the last 5 years has made a massive difference.
Oh, really? Okay.
Yeah. Like we've missed the fall in the Aussie dollar and the return of that. Like they've hedged out any currency.
Because you would have benefited from.
So we've missed all the benefits.
So for people who are trying to get their head around that, because if you hadn't hedged the Australian dollar, as the Australian dollar falls, your investments in US companies would have actually been worth more.
Yeah.
Because we price our investments in Aussie dollars, but we buy them in US dollars.
Yeah.
And so because the product is hedged, rather than getting that free kick as the Aussie dollar falls, your
net asset value or whatever it is stays the same. Yeah.
Oh, yeah, okay.
So we've missed all of that, which is slightly irritating. But it's the same story with gear. However, post-COVID, GJUS absolutely smoked the S&P 500 on the upside.
Because it was leveraged.
Because it was leveraged, but way more than gear did. Like it shot past.
Isn't that because it just went higher though?
Yeah, it just had so much more momentum behind it and just went bang. And so it absolutely smoked the S&P 500. However, it's the same story. Hasn't been able to recover since the fall in 2024.
The apples to apples comparison would have been if there's an S&P 500 ETF in Australia that is currency hedged.
Yeah, I should look at that. Didn't look at that.
Okay.
Yeah. So the story's the same. So then this got me to the point of like, right, because if you look at the since inception data for GJUS, which is the US one, so yeah, it's outperformed by about 4%, and that was since 2015.
Okay.
Yeah.
So a pretty good time to be in the US market.
Pretty good time to be in the US market.
If the takeaway is when the market is trending upwards, it's good to be in a volatile product. When it's trending downwards or going sideways, it's not good.
Yeah.
I mean, since 2015, it's been pretty good in the US.
Yeah. It is confusing because if you have a look at the returns, so for example, gear, the last, so 5 year we say is flat, 3 year is the fund has returned 20%, the index is 11.
Yeah, but that's because it would be coming off its COVID low.
Yeah.
Like 3 years would be October 2020.
Yeah. Yeah. So anyway, this really got me thinking, where to from here for these products? Because the long-term theory for the market is that the longer time period you take, like volatility, it is like theoretically less, if that makes sense. But it's more like you'd probably want to try and do the maths on it somehow or some back testing in some way to figure out like, are these products actually right for 30 years?
Someone will have done that.
Yeah.
That's something we could certainly find.
Yeah, because I know.
Why don't you take that as homework?
Yeah, I'll take that as homework because it's really got me thinking. Like, yeah, is this right for my portfolio?
But
my gut's still yes.
Okay.
Yeah.
I feel like you buried your mic drop moment halfway through this segment, which was the 5 year returns. Gear was flat. A200 was up 15%. For me, like that.
Yeah, but that's 5 years. Like if you take the 10. You're better on the other side.
All right. Well, I've just had a look at the Vanguard Australian Shares Index, which tracks the top 200 Australian stocks non-leveraged, and then Gear, which tracks it leveraged. I've gone back to when Gear was first created, so early May 2014. Gear is up 9% in that time. So in almost a decade, up 9%. VAS, in that same time period, is up 22%.
Wow. There you go.
Change your perception of leverage products, people.
Yeah, big time.
Certainly changed mine.
Yeah. Fascinating.
A lot to think about.
A lot to think about.
All right. Well, while
I think the story for me here is thank you, Will, for the question, because I wouldn't have gone deep on this had we not been for that.
Yeah.
So it's definitely changed how I think about it.
Yeah. I mean, the one thing that those returns don't factor in is the leveraged dividends. But still.
But is dividends going to make up?
Yeah, I don't think it wouldn't make up the difference.
15% difference. Yeah.
All right. Well, I think this is a good time to take a break as we ponder that. Then on the other side, we're going to have the opposite of that well-considered and researched segment that Bryce has just brought us. We're going to be calling the Speccy hotline and speak to Speccy Magee.
What the hell?
Oh my God.
Oh, it's a rocket ship.
Can you sit in that thing? All right. Welcome back to Equity Mates. We have been joined by a special guest in the studio. He's wearing his Halloween costume, a rocket ship. Speccy Magee, thanks for joining us.
Yes! Good to be back. Happy birthday, Bryce. Congratulations on the superior stock of the year, Alex.
Thank you. Good.
To paint a picture of what we're seeing here is Speccy Magee has walked in a rocket ship emoji costume that has a motor in it to keep it inflated. Which is if you can hear the... Is it warm?
It's actually kind of cools you down.
Oh, nice.
But yeah, I'll send the invoice later.
We'll certainly put some photos of this up on our socials. So go to our Instagram if you want to see. But Speccy, we always like to touch base with you to hear what's coming across your desk at Speccy HQ. You've given us some crackers in the past, some crypto coins. Banano is one that comes to mind, and a few Speccy stocks. So
nice.
What's going on in your world?
Well, it is good to be back. Thanks for calling the Speccy hotline. It's been a while. It's actually been over a year.
That just goes to show the quality.
Yeah.
It hasn't been a good time for Speccies.
Well, it's interesting you say that. So I've done a bit of research on past Speccy Magee picks. Okay, so I've come on the show 5 times.
Nice.
5 different picks. Now, before I tell you where the portfolio is at, as a comparison, where do you think the S&P 500 is at if you invested at the dates of those 5 episodes, on average?
Oh, good question.
I can give you the dates if that helps.
Give us the first date.
4th of March 2021.
Okay, so the question is, if we had invested at 5 points since March 2021, when Speccy came on the show, how much would we have be up or down in our portfolio?
Oh, we'd be up.
Are you going to guess how much? Or
But how much were we investing?
it doesn't matter. What percentage?
Matter, yeah. On average, same amount each time.
Percentage,
Yeah.
4%.
Up 4%?
No, up 22%.
So unless I've done the maths wrong, it's down 1.6%.
Oh, really?
Yeah, I think, it's quite toppish around March 2021, wasn't it? Or cooling off a
August
bit.
2021 was the top.
Ah, okay. Anyway, there you go. But I mean, more importantly, where is the Speccy portfolio? Bryce and Ren, if you're taking... Bryce is just playing around with his phone there.
I'm getting it. I'm listening.
He's playing on his phone, but he still absolutely smoked me in that game. So, all right, where's
the Speccy portfolio?
You're in a rocket ship suit.
You got to take me seriously.
I can't.
So, are you going to give us the 5 picks and then we'll guess?
That's a good call. Okay.
Yeah.
So
Banana boat.
Eye candy.
Banana. Oh, eye candy.
How many can you remember?
Eye candy, banana. Then there was the weed one. Wasn't there a weed?
There was Seller Network. I don't actually know what it does. It's a crypto. And then ITRM. It was a
I don't remember those.
No.
Like urethra tract infection drug, UTR drug.
Okay.
Well, that's what they made. And then finally, Party City Holdings.
Party City.
Right,
That's
Party
it.
City.
Yeah.
Okay, so if we had invested our money in those rather than the S&P 500, what would our portfolio be looking like? I'm going to say down 50%.
Yeah, I'm going to have to say There was some okay ones in there. Down 31%.
Well, put it this way before Speccy gives us the
80%
actual
actually.
answer. I'm pretty sure those two cryptos would be down 80 or 90%, and I'm pretty sure Party City declared bankruptcy. So,
Okay, so we're down 92%.
Party City is down 99.7. I think it's delisted.
Okay.
And so overall we're down, 79%, 80%.
Okay.
So
we would've
not
been
great.
Better off investing in the S&P 500.
Yeah.
And with that glowing endorsement of this segment, let's get to what's going across your desk today.
Okay. All right. So, and just on Party City Holdco, like I had a look through the Party House subreddit. Okay. We spoke about this last time. So they got delisted. Everyone was up in arms on the subreddit. The top comment was worst $2,500 I've ever spent. Lesson learned for a new investor: never listen to anyone on Reddit. Okay.
Nice.
Except Roaring Kitty, who
Roaring
made
Kitty
everyone
did
with
it right.
GameStop lots
Yeah.
of money.
So I thought about that and I was like, okay, I've got a year's worth of ASX bets content here that I could sift through and find a specky, right? But then I thought, okay, I'm going to take this guy's advice. I'm not going to find a specky on Reddit. I'm going to find it another way. So I was listening to the Buy, Hold, Sell podcast.
Okay. Good plug.
The Buy, Hold, Sell podcast. And, you know, everyone's talking about a recession. I'm not hearing that. I don't want to hear a recession. I want to hear a risk-on session. So Adam Dawes came on and his speckiest tip was Amero International, 3DA. So get it on record. This stock is going to the moon, all right?
Okay.
Actually, you know what? Forget about that. It's not going to the moon. It's going interstellar.
Okay.
And on that note, I'm going to leave you with one thing. I've asked an interstellar friend to give this stock tip on behalf of Speccy Magee. So here we go.
All right. Matthew McConaughey here, folks. I got a piping hot stock tip for you. I'm bringing you this stock tip on behalf of Speccy Magee and the Speccy Hotline, y'all. Forget what Bryce and Ren say. This puppy is going to the freaking moon, baby. Amero International. It's currently trading at 26 cents with a market cap of 100 mil. Amero build literal rockets that could literally go to the moon. They're a leader in 3D printing. Not that plastic stuff. We're talking boron nitride nanotubes. We're talking lightweight, high-strength designs for aerospace, defense, etc. They use cutting-edge technologies to produce refractory metals and specialty alloy powders for critical applications. Clients include names like Boeing and Raytheon. Forget about eye candy. Forget about Bonanno. Forget about Party City. The Speccy McGeezers will have their vengeance in the form of Amero and their titanium powder technology. This is financial advice. Past performance is sometimes an indicator of future performance. Strap yourselves in, folks. This has 10 bagger written all over it. We're going interstellar, dang nabbit.
Speccy Magee.
Nice. He's back. He's done it again.
We should be very clear that Matthew McConaughey does not speak for the Equity Mates community. This is not
He speaks on
financial
behalf of
advice.
Speccy, though.
Specky does not represent the Equity Mates community. But with a clear caveat to do your own research, thank you, Speccy. We'll speak to you again soon.
Nice.
Well, Ren, on that note, it is time to wrap the episode.
Yeah, I don't think there's anything that can come after
Thank you,
Matthew McConaughey and Speccy Magee.
Now, on a more serious note, please, we have a $50,000 commitment or a $50,000 challenge to hit. So if you want to see Ren shave his eyebrows, he's sitting there regretting doing that. But if you want to see Ren shave his eyebrows, then please head to our donation page. Link will be in the show notes. You can follow us on Instagram as we grow our mows. Every day we'll be doing an update, and you can also donate through the link in our Instagram page. But as always, Ren, it's been an absolute pleasure chatting stocks. We've got through a lot today. Again, if you'd like to submit a question, hit us up at ask@equitymates.com. But we'll pick it up next week.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.